Costco ended its first quarter with 77 million paid members. I wanted to talk about that and a couple of other factors about Costco for investors that are interested in this excellent brick and mortar business. Let's take a look at some of these details.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So Costco noted that they had 77 million household members, which was up 7% year over year. And they have 138 million cardholders, also up 7%. Executive members now represent 47% of members and 73% of worldwide sales. In other words, executive members spend more than regular members do. And so Costco will be happy to give executive members that 2% cash back as executive members get in exchange for the higher premium for the membership and the 2% reward. Gross margins, interestingly, in the first quarter were up by 24 basis points compared to 11.04% last year. This is the customer value proposition for Costco. They consistently offer great value to customers rather than increasing their profit margins. Their profit margins have increased very slightly over the last decade, but they've gotten better at operating the business. So what they've done is instead of absorbing all of those benefits for themselves, they're passing along that to the buyers. So as they get better at purchasing, as they get better at procurement, as they get better at logistics, they are able to lower the cost of goods that they bring into the stores. And so rather than just keeping the prices the same and lowering the cost of goods sold and thereby increasing margins, as Costco finds ways to lower its cost of goods, they lower the prices for buyers. And so they're consistently delivering lower prices to buyers. They're consistently finding ways to lower their own costs and passing those improvements to buyers. That's why people keep going to Costco. That's why Costco has an above 90% membership renewal rate. It's because Costco continues giving good value to customers, and customers appreciate that, and they've grown to trust Costco in the value that they offer buyers. Not these types of one-off values, right? Like you might see your local grocery store advertise, I don't know, a gallon of milk at a sale price, right? Every so often. Costco is more consistently offering lower prices to buyers on a variety of items. And customers don't have to try to time their purchases of certain things to match a sale that's offered by Costco. They can just go to Costco when they usually do once every month or twice every month, whatever it might be, and just buy the things that they need and trust that Costco is offering them good value for the things that they're buying. All right, here's an interesting thing that I wanted to talk about. And it's something that, unless you're an accountant, you probably don't know about, and that is LIFO. This is a inventory, I guess you can call it an inventory strategy or an inventory costing strategy. You can either have LIFO or FIFO, which is what most companies use. There are some other inventory cost management tools, but most companies either do LIFO or FIFO. And let me explain a little bit about these two. So LIFO stands for last in, first out inventory costing. So let's say you're a business like Costco and you're getting inventory all the time, right? And sometimes you're getting the same thing. Let's say a box of cereal. Like you may have in your warehouse boxes of cereal that were delivered to you in January of 2025, and you may also have the same box of cereal that was delivered to you in November of 2024. It's the same item, right? But they were delivered to you at different times. And depending on when they were delivered to you, the cost might be different, especially during inflationary periods. During inflationary periods, the costs are increasing. So the inventory that you get earlier has lower cost, and the inventory that you get later has higher cost. And so if your accounting system is based on LIFO, last in, first out, that means your cost of goods are going to appear higher than they actually are. Because your cost of goods sold, when you sell an item, you're counting it as if you sold that most recent item that you got, which is probably the highest price that you paid for that item category. So LIFO has that impact. In the opposite is true if you're doing FIFO, which stands for first in, first out. And so if you've gotten items all year long and you're selling something right now in January of 2025, and you had that item since January of 2024, and you've gotten deliveries of that same item all year, so you have in your warehouse that same item that's been shipped to you different times of the year. If you go with first in, first out, your profit margins are going to look better than they actually are, because you're accounting it as if you're selling that item that you received 1 year ago, which you probably paid a lower price, if it's during an inflationary period where costs are rising. You might say, well, why don't they just do a different strategy that doesn't have this kind of miscalculation or misrepresentation? And that would be a good question. I'm always questioning why our accounting system in the US is the way it is. It's overly complex, and I don't understand why it needs to be complex. It doesn't need to be that complex, unless, of course, you're an accountant and you're lobbying for accountants, because this creates a lot of work for accountants worldwide. And if I know there's a lot of accountants that are watching. I see you in my comment section, and I don't mean to um, uh, downplay your expertise in your industry, but it's really, the more complex our accounting system is, the more you need the help of accountants. And so that could be one reason why our accounting system has remained so complex and has these intricacies and nuances and all this other stuff that everyday people will have a very difficult time understanding. Even I have a difficult time with some of these things, other than LIFO and FIFO. If you go beyond those two, the other accounting methods become too complex even for me to start to discuss about companies' financial statements. All right. So the last thing I'll talk about here is higher employee wages that went into effect in July, drove a headwind for the quarter. And higher pressure for wages has been something that Costco has been grappling with for the better part of 4 years now, ever since the onset of the pandemic. There's been shortages, there's been pressure on wages, and there's continuing to be pressure on wages, and I don't suspect this will end anytime soon. The employment picture is getting better from a business perspective. The shortages are easing, although if the policies of the incoming president, Trump's policies, are to restrict immigration and to try and deport many individuals, that's going to create, in my opinion, if it does go into effect, even more labor shortages, which might be good news for workers because they'll be able to command higher wages. But from a business perspective, they're going to have to pay higher wages because they're going to be competing with the smaller pool of people to find for employment. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.